What we noticed last week is that it seems like there's a lot of people just trying to time bottoms right now. You look at the news, you just type in market bottom, and every single main publication is essentially saying, like, hey, is this the market bottom? Is the worst behind us? And although the market has sold off a lot, right? We've had a decent correction. It is having a little bit of a pop here as well. Taking a look at the S&P 500, you have to be cautious here because, again, it's always taking a look at our process. What's volume doing? What's volatility doing? What's that in relation to the macro process? But as you all can see, the background, the bookshelf is red, which means the S&P 500 is bearish in our model. That's the new signal on these for the people who join. And for those who are joining on YouTube as well as Instagram Live, the way that these Sunday macro wrap-up sessions work is that the first 30 minutes is streaming for all of you guys, and then the second 30 minutes to 45 minutes is just for our macro investing group members, right? And so, during that time, we're going to be going over some ideas, a little bit more in depth with the different research, answering any direct questions. And so, if you guys want part of that for the full hour, you can just go to the link in my bio or just click on the description below to start your 7-day free trial of our macro investing community. But just know that that's how these work. First 30 minutes online, last 30 minutes offline. Sometimes we talk about stuff that goes way longer too. Who knows? Depends on what the discussion goes through. But we'll go ahead and keep things moving along here. Now, with this setup right now in the S&P 500, it's still in bearish trend. And, we did have a large volume candle. And you have to remember it was the triple witching, right? It was a large options expiration day, which you can see happens, once every few months here with these large candles. And so with that out of the way, now we can really see if determining with positioning if it will squeeze higher or lower depending on what the market does. So this week will be a pretty interesting week in terms of the macro. There isn't really too many things coming up this week. Tomorrow on Monday is essentially, let's go through last week's data. So the way that these Sunday macro wrap-ups work as well is that we'll go through last week's highlights for the macro data, and then we'll go through what we're looking at for next week, and then go through some of the highlights, and then I'll go through the main indices for what I'm thinking about next. All right, so this next week coming up, or this week, the past week rather, we had core retail sales, Empire State Manufacturing Index. We had the Fed meeting on Wednesday. So let's get into some of those highlights here. Retail sales headline went down for the second month in a row, down to 3.1%. This is in line with our growth slowing measure. And so we're still not continuing to see growth start to come back, right? We're still seeing slowing growth metrics. And looking at the New York Fed manufacturing survey, that decelerated down to a low that we haven't seen since last summer. So further growth data slowing. The housing market, there hasn't been any pickup in that. Both new housing single family units starting as well as under construction remains negative year over year. And then during the summary of economic projections for the Fed meeting last week, the whole big news, which I'm sure you've heard by now, is that their projection for GDP slowed, their projection for inflation rose, and they don't have any plans on further decreasing their Fed funds rate by that much, right? So right now there's only two Fed cuts remaining in 2025, but that could change depending on how much more the macro deteriorates from here, if it does. But one of the main questions from that Fed meeting, it was actually asked 3 times, which was, Jerome Powell, if you guys are planning on inflation rising, then why do you have 2 cuts priced in at all? Why even talk about cuts? And he wouldn't answer the question 3 times. What he basically said was, we're going to be data dependent, blah, 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 his canned talk. But essentially what that contributes to is that there's still uncertainty now at the Fed level, right? What the markets really like is a level of certainty. and confidence that the status quo will continue. And so the Fed meeting from last week, is showing that they're not sure what's going to happen. And so with the Fed being data dependent, what that really translates to is they're going to be continuously behind the curve and they don't really know what's going to happen. So it adds to the uncertainty. When taking a look at the dot plot, right, you have to remember that the past 15 years, from 2008 to 2020, interest rates averaged around 0.66%, which is extremely low, right? And what they're saying for the next 5 years, or even longer than that, the average Fed funds rate is going to be between 3 to 4%, which is a 1,000% increase from where it was at the previous 15 years. So again, the higher for longer narrative is going to keep continuing. This post-pandemic era is something that is a lot different from the previous 15 years. And so those investors who are still trying to have hope that we're going to go back to the old playbook of just, picking stocks and hoping they go up, I'm not sure if that's going to be working out in the long term, because we are definitely in a different regime. Higher inflation, higher interest rates, higher volatility. Now, that doesn't mean bad news. If you're someone who can, acknowledge these trends and track it for yourself, or you're joining a community like ours, that's how you're going to stay ahead. But it's clear, even from the Fed, that they agree with that. Now, going over to the Philadelphia Fed new orders, or the Philadelphia Fed Manufacturing Index, we saw that new orders continue to decrease for the second month in a row, while prices paid increased for the third month in a row. So again, prices are accelerating, input prices, new orders or demand is decelerating. That is a stagflationary environment in the manufacturing sector, which again is a leading indicator of the economy. And then also as well, we had existing home sales come in, and this went negative for the first time in 2025 and the first time since September of last year. So the housing freeze continues. And again, with most Americans, the average American, the majority of their wealth is tied in their home. And so that's really how the middle class ends up, moving up, right? The quality of life is really measured a lot by the housing market, unfortunately. And so seeing that the housing freeze continues, that'll continue to put added pressure on the housing market, even for existing homeowners who are, expecting to refinance at lower rates. That's going to be trouble for them. And so something will crack in the housing market, whether that's, rates come down and demand comes back, or the other way around, where demand falls, supply increases and prices drop. So I really don't see any type of smooth landing for the residential real estate market, but only time will tell there. So, and then lastly, we'll talk about sentiment as well as projections for future rate cuts. Now, the American Association of Individual Investors, the AAII Bull Bear Spread, this is continuing to show that bearishness is at levels that we haven't really seen in about 3 years. Right, so this remains at bearish extremes. Now you have to be careful, because at these bearish extremes, it has proven to be profitable, at least in the short term, to be a little bit of a contrarian. And so at these low levels, it could go worse, right? There's no guarantees. But, being a little bit less bearish while everyone else is, probably it would be helpful for your process. But that doesn't mean that we're going to go bullish on the S&P 500, right? According to our metrics and our model, the S&P 500 is still remaining in a bearish trend. But for these crazy squeezes that are very potential, that have a lot of potential, especially in bear markets, you have to be aware of them. Now, going into this next week, there really isn't too much data. The main one being flash manufacturing and services PMI tomorrow. As well as we get core PCE, which is the Fed's preferred inflation gauge. That is on Friday, which I expect our team expects that to come down a little bit. We get some housing data as well, flooded in there as well, but really nothing too much. So you could have a squeeze further. It really just depends on what gets chased at this point. What is interesting is that we're seeing a different dynamic in the financial markets in terms of stress and uncertainty. So, when looking at the St. Louis Fed Financial Stress Index, we can see that that has accelerated. This is similar to credit spreads, and really it hasn't accelerated, this quickly since last summer's Japanese yen carry trade scare. And so, you would want to see this stop going up. If this continues higher, then that probably won't be great for the markets. And it's really stayed below this zero mark ever since the market, um, typically when this is above one, that's like huge market panic. So we aren't at that crazy panic level just yet, just like we were back in 2022. So there is that glimmer of hope there, but when this comes in bullish trend, which it is right now, it's broken through the December levels. You have to be cautious. Chicago Fed Financial Conditions Index, that as well broke through the December lower high here, and so that is continuing upward, similar to credit spreads. When these metrics go up, that is not great for risk taking. And then bank credit, which is one of the leading indicators that we take a look at on the private liquidity side, that remains, pretty stagnant, right? It had a local peak in November of this year. After it bottomed, it stopped going down around October of 2023, which is, similar to where the market finally took off, right? So credit turned around on a rate of change basis. But if we zoom in here, we had a pretty decent drop off in the rate of change of bank credit over the past week. And so if this continues to decline, that is obviously not great for the private liquidity markets. And so when taking a look at the next Fed meeting, which is on May 7th, the target rate probability is still an 87% chance that they're not going to cut at all, right? So the pause continues, the higher or the lower than last time for longer, I guess, lower than the peak for longer, up until June. So there's a pretty stark contrast between the May meeting and the June meeting. So the June meeting has a 68% chance that they cut by 25 basis points, and May is that they pause. So, what is the Fed and the bond market trying to price in here? What's going to happen between May and June? As you guys know in previous videos that I've done, as well as what our team talks about, is the large debt maturity wall that's coming up. We're at 70% of corporate as well as government debt is set to roll over around between now and the end of June. And so it is pretty interesting seeing how just around that time we're seeing that the Fed might start to continue to cut. Now, if it depends on the context of the cut. Remember, it's not, you can't just look at if the market or if the Fed is going to cut rates. Just like the old saying goes, it's not what you say, it's how you say it. With the Fed, it's not if they cut rates, it's by how much and why, right? If they're cutting because growth is starting to improve again and inflation is starting to tick down at a sustainable rate towards 2%, well, that's a soft landing. That's probably a good scenario where they're cutting rates, and you'd probably see a rally in risk assets. But on the other hand, if they're cutting rates because growth, inflation, liquidity is drying up, growth and inflation are decelerating, and liquidity is drying up, both on private and public. And then also too, if the labor market continues to accelerate, right? So right around that time, a lot of the government stipends dry up around that time, and then you get a flood of those government workers just coming on the market and unemployment spikes. Not saying that's going to happen, but if all those things are already coming together and the Fed starts cutting because of that, well, the context of cutting there is not so good, and you'd probably see a market sell-off, right? And so when we look at what the markets are doing right now, in my team's view, that's what it looks like it's trying to discount, right? Because you have to remember the equity markets are just a discounting mechanism. You also have currency markets. You also have the bond market. These are all trying to discount future expectations of, growth, inflation, liquidity in the labor market. And so, in taking a look at the US government bond yield, yes, it's continued to go down since mid-January, but it's pretty much been hanging out around 4.25%. And you have to remember that at the 10-year US government bond yield is where rates are typically set. Right? So credit cards, 30-year fixed mortgages, they're typically around this. And so if this current administration wants to, thaw the housing freeze and get things a little bit better under control and shift away from what the previous Treasury Secretary was doing, which, Janet Yellen, she was issuing a lot of those Treasury securities at the short end of the curve, meaning she was, issuing bills in order to, fund the government deficit. And typically you don't do that. Typically you want to do that off the long end. And so that was an unsustainable practice where now that has to be reversed. So that's what's causing a little bit of a strain in public liquidity. But that, and combined with all this uncertainty, the tariff wars, all those things, is what is, really spooking the markets. But the whole goal would be to get the 10-year US government bond yield down in a more sustainable rate, right? So just like how we were talking about, if the Fed starts cutting rates, depending on the context of what the market's expectation is of growth, inflation, liquidity, in the labor markets, if this ends up going down like this, nice and steady, again, not saying it will do that, I'm just saying that if it does end up doing this, that could be a better scenario where the market could, might be a little bit more volatile, but maybe we don't see a large crash. Whereas if it just, comes down like this, if it continues to decelerate at a very bad, pace, or very accelerated pace, then you could continue to see, a larger sell-off in the markets. So for what my team and I are looking for is the government able to get the 10-year US government down in a more sustainable way over time, over these next few months, instead of it dropping like a rock, right? So that's what we're looking for. Now, just like we said before, the S&P 500 Qs, the Russell 2000, they all remain in a bearish trend. So it's not like we're trying to pick bottoms here. And, going back to the articles that we see throughout the week, that's what everyone's trying to do right now, is pick the bottom. And the problem with doing that is you just don't know where the bottom is until hindsight happens. And so if you end up getting it wrong, which it is a gamble, if you're trying to just pick a bottom and buy here, you don't know if this is the bottom or not. And so what we do at Macro Optics is we wait for the trend to confirm. That way it gives us a lot more confidence that we're at least buying the dip in something that has a high probability of continuing to go up from here. And so right now the probabilities is that this bearish trend will continue. And so we're not just going to risk our capital and try and time a bottom. There's no point in doing that. From this moment forward, we will never try and time bottoms. That way that we don't, lose much money. But again, we have to pay attention to what growth is doing, inflation, on the chart form. We have to follow what volume is doing, as well as performance on a 3-month basis, right? All the different things that we track. And so, taking a look at the relation of the dollar, we are still also having the dollar continuing to have a bump up from here. And so things that have been having an opposite correlation to the dollar, such as precious metals, foreign equity markets, things that have been in a bullish trend over the past couple of weeks, those are having a bit of a correction, which, we'll take advantage of. And so part of what we do for our members at Macro Optics is that we publish the correlation tables that show you which assets are oppositely correlated, or there's no correlation, or they're positively correlated. That way you can stay away from things that are in bearish trend that are correlated together. An example of this would be with Bitcoin, right? I can't tell you how many people I saw were talking about how, oh, since the dollar is going down, Bitcoin should end up shooting up, right? So yeah, the dollar is going down. Let's buy Bitcoin. The only problem is that because of the macro scenario, as well as the correlation between the dollar and Bitcoin was positive, you wouldn't want to just buy Bitcoin because the dollar is weakening. And so paying attention to these correlation tables will help so that you can check to make sure, like, hey, if I do hear some type of narrative where, oh, dollar's going down by Bitcoin, how can I check that instead of just having a reaction? Because you always want to make sure you're checking with the data first. When it comes to crypto, you continue to have stablecoin dominance in a bullish trend, as well as you continue to have Bitcoin dominance in a bullish trend. And part of our rule with digital assets, with cryptocurrencies, is that if Bitcoin is in a bearish trend, while Bitcoin dominance and stablecoin dominance are in a bullish trend together, that's not altcoin season. That's our definition of, if altcoins will do well or not. And the opposite is true. If you have Bitcoin going up in price, maybe it's slowed down a little bit, but you have Bitcoin dominance falling along with stablecoin dominance, well, that's where you have altcoin season. And we're just nowhere near that right now. So similar with, trying to call bottoms with the S&P 500, if you've been trying to call bottoms in your select altcoins, you're probably being frustrated with that process, right? It's all right. But that's why you have to have these different rules and processes in place, because again, it's not like you want to have more AVAX coin, right? It's because we all invest in these things to make more money ourselves, to accumulate and appreciate our purchasing power, because that's what we want at the end of the day. We don't care what the ticker is, AVAX, BTC, SPY. Who cares what the ticker is? As long as it's making the dollars in my portfolio go up, right? So we shouldn't be tied to these things. We should just be able to have a process to where, hey, if this thing is looking like it's going to end up losing me money over the next, few months, then maybe I just get rid of it and put it in something else that's going to keep making the portfolio go up. That's what we do with using a macro process. And so, taking a look at all this, for the people who are in our macro investing community who are on the Zoom call here, we're going to be getting into the Bank of America Fund Manager Survey. So make sure you guys are staying tuned for that, as well as we're going to be going over some of our key ideas for this week coming up. A little preview of that is obviously we've been having a nice little correction in the precious metals that have been making us a decent amount of alpha over the past couple weeks, right? Gold continues to make all-time highs. We have our select subsidiaries of these precious metals, as well as emerging markets. So we'll be getting into that here momentarily, as well as the Bank of America Fund Manager Survey, which is essentially the sentiment survey for a lot of these fund managers that have at least $500 million or more in assets under management. And so for those who are watching the stream here, if you guys would like to start your 7-day free trial of our macro investing community, all you have to do is go to the link in the bio, or if you guys are on YouTube, you can just use the description below and start your 7-day free trial and join us for the next 30 minutes on the members only portion of the Sunday Macro Wrap Up. And again, even if you just wanted to, enter your information, be in there for 7 days, you can cancel it on the 7th day and it won't charge you. At least you'll be in there just to see and get a little bit more feel of the process, and maybe you can do your own research. But that is what I would recommend here. So again, we're going to continue to go live every single day during the regular work week at 3:30 p.m. Eastern time for an hour to catch the close, and then, discuss anything that, we want. But until then, I hope everyone had a fantastic weekend. For those members who are sticking around the call, hold on here while I cut off the stream. And let's all say bye to YouTube and Instagram, as well as X. Bye, guys.